The aerospace industry's basically operated like a razor blade business forever. Sell the plane engine for cheap and make all the cash back repairing it for decades. But the CEO of RTX just said that whole model has to die.
He did. And when a company sitting on a backlog this huge says the fundamental economics need fixing, you tend to listen.
Yeah, they definitely got the market's attention today. Welcome to Earnings Unscripted. It's July 23rd, 2026, and we're looking at RTX's second quarter. Last time around, they posted great numbers, and the stock just drifted. Today, it gapped up hard early on and closed up over 7%, which, as a quick heads up, this whole show's just our personal read on the market reacting, not actual advice for your portfolio.
Right. Well, I mean, the tape finally caught up to the operational throughput. You look at revenue, it came in at about $24.7 billion. Earnings also easily cleared expectations at $189 a share.
And that top line grew by 14% year over year, which is no joke for heavy manufacturing.
No, it really isn't. But honestly, the bigger tell is the free cash flow. It more than doubled from last quarter. A good chunk of that was just Pratt & Whitney finally working through the repair backlog from last year's work stoppages.
Right, and getting all those grounded planes back in the air is huge. But they're also just executing faster on the defense side, too. Raytheon took that Stormbreaker smart weapon from a pure concept to a flight test in under a year, which in government contracting timelines is basically light speed.
Absolutely. Raytheon's growing double digits because land, naval, and air systems are just flying off the line. Their overall backlog just cracked a record $289 billion, with international demand clearly shifting into overdrive. But that takes us right back to Kallio's comments on the commercial engine business.
Okay, wait, how does a massive defense backlog connect to the commercial airplane engines?
Because capacity costs cash, and he's looking at the capital they need to build out the next generation of passenger jets, and he's flat out rejecting the old idea of funding front-loaded deficits.
So wait, I need you to translate that for me, because it sounds like he's actually threatening to make the airplane builders start footing the bill up front.
That's precisely what he's implying. I mean, Kallio was unusually blunt about it. He literally said, I think the idea that we're going to invest all this money up front and then, again, not have high margins on deliveries and then rely on anywhere from 4 to 6 shop visits over a 25-year period, I don't think that is the best model going forward.
Okay, wait, walk me through that. If they stop, essentially giving the engines away at a discount, wouldn't the airplane builders just walk away? Like, go find another supplier?
Right, except where are they going to go? There's basically a duopoly making these specific engines. So what Kallio's talking about is the next generation of planes. They call it the NGSA, Next Generation Single Aisle. It's still years away, and he actually noted, we continue to believe that NGSA is going to continue to move to the right because the industry needs stability.
Oh, move to the right as in delayed. So while Airbus and Boeing are pushing timelines back, they're looking at the cash drain and saying, yeah, we aren't going to act like a bank anymore.
Exactly. Especially when they can't even keep up with the work they already have. That backlog we talked about is practically crushing them.
True. You don't offer discount financing when people are lined up around the block. Which, actually, that brings up another wild detail I saw. You mentioned they're churning out weapons fast, but apparently they're formalizing agreements with non-U.S. suppliers just to build defense hardware?
Yeah, they've basically tapped out their domestic production. Raytheon's openly engaging the international defense industrial base. They're making these co-production frameworks with European partners standard operating procedure. It's a huge admission. They literally can't build things fast enough here in the States.
Wow, so we're at a point where U.S. defense contractors are outsourcing just to keep up with European demand. That's honestly fascinating, but logistically terrifying. How do they even manage the supply chain for that?
With massive buffers. And that's a huge pivot for them. Originally, the plan was to lean out their working capital, right? Be efficient, free up cash. But the CFO admitted they've totally shelved that idea. Now they're intentionally building up raw inventory. They know the supply chain's too fragile. So they're sacrificing short-term cash flow optimization just to ensure they have enough parts to keep production moving late into the year.
Okay, so efficiency's out and hoarding is the new normal, which, considering all those geared turbofan engines still waiting for repairs, is probably a necessary evil.
But if they're purposely tying up cash in buffer stock just to survive the current crunch, what happens when that original equipment pipeline actually starts slowing down?
Well, that's not really a hypothetical. I mean, they're already forecasting that exact slowdown. Pratt's original equipment sales they're deliberately projected to drop for the year because they're hijacking their own capacity. They basically have to shift resources away from building new engines just to clear out that massive repair logjam.
Wait, so they're intentionally throttling new deliveries to fix the broken stuff? That feels like a brutal pivot when airframers are screaming for product.
It's a tough call, but they don't have much of a choice if they want airlines to trust them. And management definitely sees the slowdown coming. Even though they just raised their full-year adjusted sales outlook to somewhere between $95 and $96 billion, they actually warned that the momentum is going to moderate.
Okay, I need a second on that, because lifting the guide by that much while telling us things are slowing down is a very weird mixed message. How steep of a drop are we talking?
Pretty noticeable. First half organic growth was running hot, around 13%. But the new guide implies the back half of the year drops to roughly 5%. And the CFO, Neil Mitchell, was blunt about it. He said, in fact, we now think our OE sales for Pratt will be down in the low single-digit range as we continue to support that really strong material growth on the MRO side.
Right, so they're trading high-margin original parts for lower-margin heavy maintenance. That makes sense mechanically, but it means their operating leverage could take a hit. Plus, Collins was complaining about tariffs biting into their margins this quarter too, so those pressures are definitely stacking up.
Exactly. They're proving they can clear the bottlenecks, but the next quarter is all about margin defense. That, and we really need to see when the Pentagon formally signs off on those massive framework agreements. RTX is already spending prep money to support them, but those deals still aren't officially in the backlog.
Yeah, doing the work before the check clears is a tough game. It's going to be fascinating to see if they can balance the factories without burning all that cash. All right, I think we've picked this one apart enough for today. Thanks for hanging out and figuring this out with us, everyone.
Catch you next time.
If you enjoy picking apart these reports, tapping follow on your app is a great way to catch the next chat. And just a heads up, this entire show is an AI experiment. Our voices and the dialogue are completely synthetic, built to take RTX's backlog updates from the earnings call to your feed on the exact same day. We'd love to hear your ticker requests, so drop us a note at earningsunscripted@datamadness.ca or find our X link in the show notes. Take it easy out there.
See you next time.